Hello, everyone. This is Sebastian McMahon from IA Financial Group, and I'm here to bring you the last weekly economic review of the winter because spring is at our doors. And as usual, I'm joined with our chief economist, Clément Gignac. So, good morning, Mr. Gignac.
Good morning, Sebastian.
So, it was a pretty quiet week on the data front. It was the Fed that caught our attention. So we'll dig a little bit into that before we'll look at this week's markets at the close on a Thursday. So the hemorrhage continues in bonds. So interest rates are still going higher. So on the week, minus 1.2% for the long bond index. Year to date, minus 12.3% on the index. The global market, the universe index, minus 5.73%, and corps minus 4.3%. Of course, these are all Canadian indices, but the situation is similar pretty much everywhere around the globe. Equities, if EFI was higher, so EFI is Europe and Asia, so we had a good week in Europe. Almost neutral in emerging markets on the TSX, and more negative in the US and especially on the Nasdaq. So the trend continues. Last year's winners are being sold off. The cheaper markets are being bought. So the theme continues. In other market, the price of oil was down about 9%. No clear catalyst here. It's just we had the very strong price action recently, and there was some profit taking. Canadian dollar remains above 80 cents on the dollar. Euro down a little bit, and the price of gold up 0.5% year to date. We are still negative 8.5% on this one. So COVID. So here an update on the current situation. On the left, Israel is a very small country, but it's a good experiment here to with relative to the vaccine. So it gives us lots of information. We know from the data there that the vaccines supposedly are even more efficient than expected. And as you can see on the left, the green line is falling like a rock off a cliff. So that's a good sign that the vaccine is making its effect felt. I don't know if you've all seen, but in the news we've seen some pictures of people eating in restaurants and outside, and it kind of makes us dream of the life that we had before. And it's at our doors too, because the vaccination campaign, if you look on the right, are only 7.4% of the population, the share of Canadian population having received at least one dose of the vaccine. But we are on the cusp of a strong acceleration here. So in the next few quarters, we should be seeing strong acceleration. And even here, where we are based in Quebec, we had the Prime Minister saying that by June 24, every adult that wants to be vaccinated should be. So this should be the trend that we'll see in Canada. So very encouraging news. Maybe just a word on Europe here. You have two charts on the left. You have the US on the right. You have the Europe. You have Europe. In both charts, you see the GDP pre-COVID. Then you have the trend, the pre-crisis trend that is extrapolated towards the future, and you see the drawdown. Well, there are one main difference between the US and Europe is that in the US they were so generous, so active with the fiscal stimulus that the economy should go back to the pre-crisis trend as early as late or even mid to 2021. So we'll see where we are, but in the second half of this year we should be back on trend. In Europe, of course, it's a more decentralized government. It costs a lot of political capital to put together such a package. So it would be surprising to see more fiscal stimulus in 2021, or at least in the intensity that we saw in the last 12 months. So we should see the European economy having a hard time going back to the pre-crisis trend all the way through 2022. So even though the economy should be lagging a little bit, the European market is very cheap. It's more cyclically based, so we still have a very positive outlook on European equities looking forward. Just like we've seen this week, it's cheap, and this is where the money is flowing now. Federal Reserve revising its outlook higher, but still not seeing hikes before 2024. So Mr. Gignac will be discussing the market impact, but here the forecasts from the FOMC committee, so the Fed on the left, you have the GDP growth expectations. So in March, the Fed is expecting 6.5% growth in 2021. It was at 4.2 in December. And the second red box that you see here, it's the PCE inflation. So they are now, and they're persisting, and they are sticking with their story that inflation should be temporary. So they rose their expectation from 1.8 to 2.5% in 2021, and then they see 2% inflation on average for 2022 and 2023. So they are not worried about inflation, and they repeated that message. On the right, you have the blue dots are the December 2020 forecasts for voting members, and the green sticks are the March 2021 forecasts. So what that tells us, the blue dots are telling us that in December, no one saw any hikes in 2021. Same thing for the March 2021 meeting. In 2022, in December, only 1% saw a rate hike in 2022. Now it's 4%, and in 2023 it used to be 5. Now it's 7%. So it's not enough to say that there's a consensus. So we still say that the Fed does not see any rate hikes before 2024 because it's a small subgroup, but that still means that it's making progress there. So maybe as the year comes forward, if we do have stronger economic data coming in, we could see more and more members rallying to that view. And at some point, the Fed could start hinting towards at least maybe a hike in 2023 and move on from there. So movement there. So the Fed is staying pat, but it's still starting to lean slowly in that direction. Finally, in Canada, the good news keep on coming. Inflation remains subdued. On the left, you see the V-shaped recovery of manufacturing sales, strong V. After that, it went sideways and started going up a little bit. This morning, we had retail sales, which were actually pretty good in January. So it was a fall of only 1% compared to December. It was expected to be a minus 3%. And the flash estimate from StatCan, kind of the forecast that they're making, is that we could have 4% month over month growth in retail sales in February in Canada. So remember that last time the Bank of Canada made a forecast, they were expecting minus 2.5% in Q1 for GDP, so a contraction. Now the consensus is at plus 2.5, so we're still already way beyond what the Bank of Canada expected. And with this kind of positive surprises that we're seeing, there's even more upside to that. So as I mentioned, very strong momentum here, or at least stronger than expected. And the vaccination should accelerate after that. So expect a very strong year here for the Canadian economy. So that wraps it up for the economic part. Now for the financial markets, I'll hand it over to you, Mr. Gignac.
Yeah, so thank you. So very encouraging when I see your charts and you refer to the fact good news restaurant picture with people at a restaurant. And guess what? Good news for me because 1 year after the WHO has declared pandemic situation and the trough of the market, I got my vaccine appointment. So I'm very, very, very happy, of course. And I'm in the 65 years old, not 75, 65. So still in good shape, but nonetheless, a pretty good news. Okay, back to the market. So it was a busy week in the past week. You have referred to Mr. Powell. And as you mentioned, they have revised the economic forecast and so on, but it was more or less copy paste on the press release. He has done a good job in the on the press conference, so I gave him a 9.5 on 10 because in the past, from time to time, he dropped the ball and the market move during the press conference because he have not chosen the appropriate word. This time, he stayed to the script. So it was a maestro to come the market. But you know what? That lasts only 3 hours because the day after the bond yields start to rise again and so on. And even today, they continue to rise this morning on Friday as we record. So people, market have concern about inflation. So inflation expectation, that is the survey from Bank of America. We have never seen such a high concern about inflation in the last 25 years. So time will tell if central banks are right or wrong with the optimism that the pressure on inflation would be just temporary. So we see for the time being, the market, in fact, want to just to take profits and run. This is what we see on the bottom, on the long bonds. Next chart, just to illustrate what is the impact on the bond market. On the, I have an example of an ETF to the price of the long bonds. If you have a long duration, you are more affected when interest rate going up. So make no mistake, treasuries is safe assets because you're sure that government will pay you at the end of the maturity. But in the meantime, if interest rate increase, you have a loss, okay, on paper, okay, it's a loss on paper. So mark to market, notice what happened. For example, the long bonds, Treasuries US 20 years plus, it trade at $170 last summer. Now it's $135 and continue to drop this morning. It's a pretty significant adjustment. When you have a low coupon, the market is very sensitive to each basis points increase. And since the beginning of the year, that in fact, the bonds has increased close to 75 basis points if you talk about the long rates. Okay, so very significant. Notice on the right side, we have data since 1973. What is the drawdown, the impact when you have a sharp increase of long rates? Notice this is the third now largest drawdown in U.S. Treasury ever recorded since 1973 in the last 10 weeks. So that tells you something. Is it over? I'm not sure because interest rate is still very low in the context that if you, with the huge public debt that we have in inflation acceleration, a fair value of a 10-year treasuries is probably closer to 275.3, and it's still at 175 as we speak. So I just want to share with you that the good news is with your advisor, normally they have diversified because the portfolio manager diversified the bond market. They have low maturity and they have a high yield with a corporate investment grade. They have a higher coupon. They are less affected by an interest rate increase. But nonetheless, don't be surprised when you will see your next statement that you will see that in the first quarter, the bonds, in fact, value has declined. Next slide. We talk about, in fact, the relative. So you have the NASDAQ here with the 10-year bond yield, the relationship. Notice when the 10-year bond yield going up, which is, in fact, the blue curve, notice that the NASDAQ start to suffer. NASDAQ is a proxy of a technology sector. It suffer compared to Russell Min, which is a barometer of a small cap. So acceleration economy is very good for the small cap company in US, but it's a less good news for the technology sector because technology stocks, when they trade at 30, 40, 60 times earnings, in some cases they have no earnings at all, 20 times, 15, 20 times earnings. Guess what? When interest rate going up, the opportunity cost increase. So that affect, in fact, energy stocks. Next slide, which is the last one. It's on the Wall Street. On the left side, you have the earnings on the S&P 500. So notice now the expectation would be 180 for 2021. It's exceed the previous COVID-19. So we can see that even if we still have a lot of people, a million people unemployed in US, as far as the earnings is concerned, the earnings recession is over for already some time, and now this is a productivity boom, what we experiment right now, and that help so that compensate the increase of interest rate that support the market. If you have more a 12 months time horizon rather than 12 weeks or 12 days, I'm optimistic. Okay, so we will have a positive return. Notice here you have each period in the last 25, 30 years, and each period of increased interest rate, and notice sector by sector. Financials, whatever the period, are the obvious winner, the number one, with 27% in average upward return. Okay, notice the S&P, all the period except the period after the dot-com bubble being bust, they are positive return. This time is not the bubble like .com on the NASDAQ, but it's still very expensive. That's the reason that my expectation of total return on the S&P 500 for the next 1 month is more modest. It's not double-digit return. is more mid-single digit return. But if you go with sector rotation and with active portfolio manager, I think that you will be able to go through that volatility period. Sebastien and myself manage close to $10 billion. In fact, we overweight the financials in our strategy. So, sorry, I've been long a little bit, Sebastien. We have a lot of things to watch next week, huh? Or not?
Sure, sure, and it's not a mistake here. There's no major Canadian economic data coming out next week. The next data point that we are really looking forward to will be on March 31st when we get the GDP for January in Canada, and we'll have January and we'll have the flash estimate from StatCan for February. So it should confirm this view that there's upside risk for the start of the year, at least for the Canadian economy. So a very good handoff from last quarter plus a good start would mean good things for 2021. In the US, we'll have new home sales, we'll have durable goods orders, we'll have the market US manufacturing PMI, which should be at about 59.7, which is historically pretty high. So still a very good momentum there in the US. And personal income, no, it's not a typo. It's and there's nothing wrong here with the US economy, minus 7.3% month over month, but it's because of course Americans got checks in the stimulus checks in January, and they should get even bigger checks in March. So in February, between the two, it was a bit of a drop, but expect the March figures when they come in to be much stronger than that. So very strong tailwind here for the U.S. economy to start the year. As usual, if you want to follow us, ia.ca/economy. If you haven't done so, you can subscribe to the newsletter in the box on top. If you want a PDF copy of this presentation, just write at economics@ia.ca and we'll forward that to you. So thank you everyone for your trust. Thank you, Mr. Gignac, for your comments.
You're welcome. Have a nice weekend. And spring started tomorrow, as you know.
Yeah, we'll try to enjoy it as much as we can. So good. Thanks everyone. And we'll be back next Friday with a new edition of the weekly economic review.